I'm Charlotte McLeod with the Investing News Network, and here today with me is Alfonso Peccatiello, founder at the Macro Compass. Thank you so much for joining me online today. It's great to have you here.
It's a pleasure to be here.
Really nice to be speaking with you. And just to give our audience some context, I had reached out to you after I read your piece on the de-dollarization fairy tale. And it was really interesting to me because you went over, why do we hear about this all the time? We never see it happen. So I want to talk about that today and probably begin with a basic question, which is, why are we hearing so much more about de-dollarization right now than we might have in the past?
So the reason why we're hearing it more today is that the US sanctioned Russia after the invasion of Ukraine, which basically meant that as Russia over time had been selling mostly crude oil and accumulating dollar reserves, they found all of a sudden that all these hard-earned assets were basically frozen. They couldn't use their dollars anymore. And so from that moment onwards, there has been quite some movements under the surface regarding countries that generally sell services, goods, and commodities like China or Brazil, for example. They accumulate dollars when they sell these services, goods, and commodities, and they've been thinking, do I want really to invest all my hard-earned dollars into treasuries that can be, in principle, made unavailable by the US government itself? So there has been a lot of talks and movements under the surface when it comes to the de-dollarization. But as I wrote in my article, you keep hearing about it, but it never happens. So we need to talk about it. Why do we keep hearing it all the time? Sometimes a bit louder, sometimes a bit less, but it never happens.
Right, and you go into a couple of pretty good reasons why that we hear about it and we don't actually see it happen. So I wonder if you can talk a little bit about why this is such a difficult process. And I think to be clear for everybody, it's not that you don't think we're going to see this. It's that when we do, it will be very tough.
That is correct. So the thing I want to fight the most back against is this idea that we can have an orderly de-dollarization. That's a fairy tale. It can't happen. So let's explain why. Basically, since the 80s, 90s, we have globalized the world. We have expanded global trade. So we have countries all over the world that are able to negotiate and trade against each other, sell and buy from each other goods and services. In order to facilitate this process, we have chosen the dollar to be basically the denominator of most of these transactions. About 70 to 80% of all global foreign exchange and global trades happen to be denominated in dollars. Now, what that means is that the dollar generally gets, and the US generally gets, tainted with this exorbitant privilege of having the global reserve currency. And as I wrote in my article, it's a privilege, but it's not easy to be the dollar. And why? If you are the global denominator of all trades and transactions, it means, as we explained, that Brazil, for instance, selling commodities will accumulate dollars. When they accumulate dollars as the result of selling their commodities, they will need to park these dollars in a safe and liquid asset to make sure that it doesn't get to waste, basically, so that the result of their transaction remains fruitful. Now, in order to be the global reserve currency of the world, you need to service this large amount of global dollars with a market where they can be parked in a safe way. That's the US Treasury market. Now, if you want to be the global reserve currency in the world, you have to have a deep, liquid, and very transactable bond market that can accommodate all these dollar flows coming from global trades growth. When people tell me, we're going to move away, we're going to de-dollarize, then my question is, we're going to move to what system? And if we stay within currencies, and we will talk about gold and the role it can play into this transition, but if we talk about standard currencies, if we move away from the dollar, is there another currency today that can provide with a deep, liquid market where you can recycle your hard-earned money? And if I look at the euro or I look at Japanese yen, we're looking at countries that have either the bond market basically completely owned by the central bank, that's Japan, or we have Europe, which is a very fragmented, fragile union with a monetary union, but not a fiscal union, not a banking union. So basically the dollar doesn't have a competitor when it comes to having a market that provides with a deep and liquid treasury market where to recycle your currency.
Okay, thank you for explaining that. I think that makes a lot of sense. And one thing that I also wanted to bring up is I think part of the reason we're seeing de-dollarization making headlines right now is we're hearing about the BRICS countries. They want to have a new currency. So what are your thoughts on that? How does that fit into the picture here?
So that's a good question. And we heard President Lula that actually at the BRICS conference said, why do we need to depend on the dollar? Why can't we just have a BRICS national bank that basically makes sure that we have a common denominator, a common currency that underpins all the transactions between the BRICS currencies so we can just walk away from the dollar? Well, that goes to hit the other side of the coin because so far we talked about dollar assets being accumulated as selling goods and services and in need to be recycled into a safe market, which is the treasury market. What about liabilities? Because look, one of the reasons behind the growth of the role of the dollar over time as the global reserve currency is also the dollar debt market. So there is a $12 trillion big market, which is basically the dollar-denominated debt market. So those are bonds issued in dollars by entities not residing in the United States. In other words, a Brazilian corporate, a Chinese corporate that issues dollar-denominated debt. Why do they do that? Because if their business on the asset side is denominated in dollars, to generate more business, well, you need to borrow and to lever up in dollars. But the moment they do that, they basically become entrenched into the dollar system because to service your dollar debt, you need the dollar cash flows. The moment you walk away from dollar cash flows and you start selling your commodities in yuan or in a BRICS currency, where are you going to get your dollars to service your dollar debt? Now, the choice at that point is to default, to say, look, we are not going to pay back the dollar debt. But by doing that, what is the message you will be sending to the rest of the world? That you are not paying back your liabilities. So you will be isolating yourself. The world will become even more bipolar than it is today. And I'm not sure that China, Russia, or Brazil are looking exactly for that.
All right. So when people hear about these big themes like de-dollarization, I think they wonder, how does this happen? What does the process look like? Because it's such a massive concept. And you had referenced the role that gold might play in having this happen. So I wondered if you could help us take a look at that. Tell us what you see coming there.
So look, we talked about the alternatives to the dollar, both from an asset perspective and from a liability perspective. Who's going to want to issue debt denominated in Brazilian real or in Chinese renminbi? Who's going to want to invest their hard-earned asset into a Chinese bond market where you know that your money can just be basically seized through capital controls? So that's why I don't think that an orderly move from a dollar-based system to another currency or a basket of currency-based system can be an orderly one. Generally in history, such transition between global reserve currencies happened with big geopolitical tensions, or in other words, with wars. So nobody wants that, but it is, historically speaking, the prerequisite to move from one currency-based system, the dollar, to another currency-based system. The other transitions we have seen in the past is the move from one currency-based system, the dollar, to a gold-based system, and that is something different. Why? There are two main reasons. The first is, in a gold-based system, what you are doing is you are pinning the growth of debt and credit to the existence of a hard asset. You can always exchange newly created dollars or newly created fiat currency for gold at a fixed price. What that does is it limits the ability to expand our credit, our debt, our leverage infinitely, because you know that the more fiat money you create, the more the risk it is that people are going to lose confidence in that system because they expect the peg not to hold anymore. So there is a hard asset, basically, that pegs the creation of credit. Now, gold has basically always and already in the past served that role relatively well. And why? Because it already sits on the balance sheet of all these institutions. And it does so even more strongly today. We have seen global central banks accumulating gold. So they're buying more of this asset, putting it on the balance sheet, because in case we have a transition from a global reserve currency-based system, the dollar system, to something else, they know that rather than a basket of currency, the best option they have from an historical perspective is to use gold as the asset that underpins the new system. This has been done already, actually 70, 80 years ago, last time, And this is also why I think global central banks like Russia or the Chinese central bank are accumulating more gold rather than thinking about the BRICS currency in itself, because gold would sort out quite a lot of problems and would also be welcomed, I think, from many investors that have already seen that system somehow work in the past. They haven't seen a system working based on a BRICS currency. They have doubts about the rule of law and capital controls and corruption. For instance, in Brazil, you don't have doubts about gold being a hard asset that underpins a new system. So I think gold can and should play quite an important role in the transition from a dollar-based system to another system.
That's very interesting because I do think it's no secret how much gold the central banks have been buying lately. So in your view, perhaps they see this coming. That's why they're snapping up all of this gold. I wonder, in the transition to this potential gold-backed system, does the power then shift to the countries that hold the most gold? Because I believe then when it comes to central bank reserves, that is still the US at the top of the list again.
Yeah, and that's a good point. So, of course, also the US, but European central banks as well, the domestic central banks, own quite a decent amount of gold. And that's no surprise. Gold is also a hedge, basically, in case you would move to another system. The more gold you have, the more power you have in a system that obviously is based on gold, right? And where gold is the hard assets that pin and relates to when it comes to credit growth or debt growth in the new system. So what I'm seeing lately is that other central banks that before didn't have a large share of gold into their asset ownership, now they're turning more towards gold. So this would be central banks like the PBOC, the Chinese central bank. They are trying to move away from the large ownership of dollar-denominated treasuries into gold in order to make sure that if there is a transition, they are better positioned to handle that transition too. So I believe that rather than seeing a bipolar world where we are looking at the dollar-centric world against the BRIC-centric world and a transition towards another basket of currency-backed system, if we would see a transition, it wouldn't be an orderly one either. But that transition is more likely to be a transition from a dollar-based system to a gold-based system once again.
I am curious what happens to the price of gold if we potentially do see this happen. What do you think about that?
Oh, well, I think it's pretty simple. If you want to transition from a dollar-based system, a debt-based system, a credit-based system into something else, what you have to do is you have to basically deleverage that system first. So when you deleverage that system, what happens is everybody who has debts, credit denominated into that fiat currency has to or is forced to deleverage, to shrink it down and to try and move their wealth towards a hard asset. The hard asset of choice is gold. So what happens in that case is that you basically have asset prices that take a big hit, the stock market, the real estate market, all assets that have been based on debt, on the increase of leverage in the system, get penalized. The assets that do the best are the hard assets. So money tends to flow towards these hard assets in that case. And look, it's hard to put a number on it. On gold, of course, the price would move up pretty materially. The way I think about the role of gold in a portfolio is you don't know when and if this transition is going to happen, but when and if it happens, you want to have some gold in your portfolio to protect your wealth in that environment. You don't need to become rich because of that, but you need to have gold in your portfolio as a contingency towards that transition. So that's why I think the role of gold in portfolios is not only short-term related to what the Federal Reserve will do this week or a week from now, but it is also long-term insurance against a transition to a gold-based system.
All right. And one more question on de-dollarization before we try to put some of this into broader context for everyone. You know, when we're hearing about all these things, one of the headlines that I've seen is, you know, the death of the dollar. To me, that sounds a little bit dramatic. And I wonder what your thoughts on there. Is that an overblown concern?
Well, the funny thing about deleveraging the system based on the dollar is that when everybody tries to move away from that system, they need the dollar in the first place to move away. That's a funny story, but think about it. If you have dollar debts, how do you pay back your dollar debt? How do you deleverage that system? Well, you need dollars to pay back your dollar debt. So when you deleverage a system, funnily enough, you have situations when the dollar appreciates. This is also the reason why when there are periods of stress, credit events, big deleveraging episodes, we often see the dollar appreciating. And that's what people tend to forget. The dollar is so much rooted into the system that to get away from the dollar, we first need to have a period in which the dollar appreciates. I know this sounds counterintuitive, but this is how the system works. This is how deleveraging works. The death of the dollar has been proclaimed over the last 50 years, I think 20 times already. And we actually tend to see that the more the system becomes leveraged, the more vicious these dollar appreciation moves tend to be, like it was, for instance, in 2022, when the Federal Reserve was increasing interest rates rapidly, and the over-leveraged market, like the real estate market or the credit market or tech stocks, for instance, were taking a large hit, and the dollar was appreciating. So dollar deaths are always premature. If we're going to be seeing one true dollar move away from a dollar-based system to something else, funnily enough, this would probably include a period in which the dollar appreciates even more, but that's going to be the last time it does so.
All right. Okay. Really interesting. Thanks for going into that as well. Now, I mentioned we should try to put all of this into context for investors. I think people, when they hear about these high-level topics, they wonder, how does that actually relate to what they're doing with their portfolio? What does it mean for them as an individual? I wonder if we can talk a little bit about that, because there is so much uncertainty in the world today. We have the Fed meeting this week. We may not publish this interview before then, but it's happening. We've got banking system issues in the US. We've got so many things going on. What does an investor do?
Look, I think we need to get some perspective here. We have been talking or been hearing about the Fed pivot coming anytime soon, right? And that has incentivized investors lately of taking risks back into the market, buying the stock market, buying even unprofitable tech companies back again. So let's take a step back for a second. When the Fed pivots, and if it does, you always need to ask yourself, why is the Fed pivoting? What is the reason behind this? So in 2001, for example, the Federal Reserve did pivot. It cut interest rates by 475 basis points in 15 months. It basically brought interest rates from 6% all the way down to 1% in a bit more than a year. That is a big pivot, right? A super dovish pivot. If I'd ask you, what did the S&P 500 do in 2001, you would say, well, the Fed pivoted, it must have rallied 20%. And the answer is no, it didn't. It actually dropped 12%. And why? That Fed pivot came because the US economy was going into a recession as the result of the Federal Reserve trying to stop the tech bubble, raising interest rates in 2000 to levels, 6%, which prolonged over time damaged the US economy. So the Federal Reserve was forced to pivot, but unemployment rate was going up, earnings were coming down, deleveraging was happening, so the stock market didn't perform well. A similar episode could happen this time. In 2022, the Federal Reserve has raised the interest rates from basically 0% to 5%. That's where we're going to be most likely as we speak next week. Now, with such a rapid tightening of monetary policy, with fiscal stimulus basically having exhausted this effect all the way back at the beginning of 2022, you're looking at an economy that needs to withstand tight interest rates, tight borrowing conditions for a prolonged period of time. And inevitably, this will slow down the economy even further. So yes, a Fed pivot might come, but the reason why it comes is to try and repair the damage that has been done to the economy by raising interest rates to slow down inflation. That is not an environment where you want to be super positive, where you want to scream that there is a new bull market around. When the Fed pivots because things have gone bad, you are supposed to act defensively with your portfolio. Have bonds, have gold in your portfolio rather than having a lot of stocks. That's not yet the moment to be aggressive. It's the moment to be more conservative.
That's very helpful. And just before we wrap up, I have a question about your overall strategy. So you take a really macro view of what's going on. You do a great job of breaking that down. I wondered how you filter through. There's so much out there that you can look at. How do you filter through and find the important points to pull out for people?
Look, it's a super valid question, and it's true, we are inundated with information, and that's why one of the things that I tend to do at the Macro Compass is try to use a data-driven approach. So basically standardize the process and know what data to follow, how to analyze it, what to focus on, and build basically some mental models and frameworks to gather all that information and put it all together. It's not an easy task. And I've been a professional investor for 8 to 9 years. You are inundated with information. The problem is how to organize it, really. And that's one of the main things I try to do at the Macro Compass, really break it all down in plain English and make sure there is a systematized way to follow all this macro data, to model it, to understand what's the best tactical and strategic portfolio allocations to have. Not an easy task. Everybody has its own models, but I think it's important to understand also the first principles behind the macro analysis. And the last 10 years, Charlotte, have been, I think, a bit numbing investors down to macro. Why? You just would buy some bonds and some stocks and go to sleep, and your portfolio would make 10% return a year. And I don't think that's the environment we're going to be living in because of these geopolitical tensions, because of the volatility around inflation, the volatility around GDP growth. Investors need to understand how to do macro analysis properly.
I agree. I think that's really important. And just as we're wrapping up, if you could let us know where we can find you, tell us a little bit more about the Macro Compass.
Thank you. So all I do, all the macro research, the investment strategy, the portfolio strategy I do is on themacrocompass.com. So every week what I do there is I try to break down what's happening at a macro level in order to make it understandable and actionable for the average investor out there. I've been a professional investor myself, managing a lot of money for a large bank, but honestly, I think there is much more value in trying to sharing a macro framework with investors so that they can understand what's going on in the world and how to make a framework around it so that your portfolio strategy can also be deployed. And that's all on themacrocompass.com.
Perfect. Well, thank you so much for joining me today. We'll leave a link below so people can check it out. I hope that they do, because your publication really has helped me understand some pretty complex topics. So thank you so much for coming on to talk. It was really great to have you.
Thank you. It's been a pleasure.
Great. And once again, I'm Charlotte McLeod with the Investing News Network, and this is Alfonso Peccatiello with the Macro Compass.